Welcome. Today we're diving into the world of Forex orders. If you've ever wondered how traders enter and exit positions in the Forex market, this video is for you. We'll break down the different types of orders, explain how they work, and show you when to use each one. Whether you're a beginner or looking to refresh your knowledge, understanding order types is crucial for effective trading. Let's get started by defining what an order is and why it matters in Forex trading. Forex trading, an order is simply an instruction you send to your broker's platform to open or close a trade. Think of it as telling your broker exactly how and when you want to buy or sell a currency pair. Orders are the backbone of every trade, and knowing how to use them gives you control over your trading strategy. Different brokers may offer different types of orders, so always check what's available on your platform before you start trading. Forex orders generally fall into two main categories: market orders and pending orders. Market orders are executed instantly at the current price, while pending orders are set to execute at a specific price in the future. Understanding the difference between these two categories is essential as it determines how and when your trades are carried out. Let's take a closer look at each category and the specific order types within them. Market order is the simplest type of order. It tells your broker to buy or sell a currency pair immediately at the best available price. For example, if EUR/USD is quoted at 1.21412142, and you want to buy, your order will be filled at 1.2142. It's like shopping online with one click, fast and straightforward. However, keep in mind that in fast-moving markets, the price you see may not always be the price you get due to slippage. Pending orders allow you to set trades that will only execute when the market reaches a price you specify. This is useful if you want to buy or sell at a better price than what's currently available. Pending orders include limit orders and stop orders, each serving different purposes. Let's break down these types and see how they can help you automate your trading strategy. Limit order lets you buy below the current market price or sell above it. For example, if EUR/USD is at 1.205 and you want to buy only if the price drops to 1.203, you'd set a buy limit order at 1.203. Conversely, if you want to sell only if the price rises to 1.207, you'd set a sell limit order at that level. Limit orders ensure you get a price equal to or better than your specified level, but there's no guarantee your order will be filled if the market never reaches your price. Say the current price of EUR/USD is 1.205. You believe the price will drop before rising, so you set a buy limit order at 1.203. If the price falls to 1.203, your order is triggered and you buy at that price or better. This strategy is used when you expect a reversal at a lower level. If the price never drops to 1.203, your order remains unfilled and you miss the trade, but you also avoid buying at a less favorable price. Now imagine EUR/USD is at 1.205, and you want to sell if the price rises to 1.207. You set a sell limit order at 1.207. If the price climbs to that level, your order is triggered and you sell at 1.207 or better. This approach is useful when you expect the price to reverse after reaching a higher point. If the price never rises to 1.207, your order stays pending and you avoid selling too soon. Stop entry orders used when you want to buy above the current market price or sell below it. For example, if GBP/USD is at 1.505 and you believe a breakout will occur if the price hits 1.506, you can set a buy stop order at 1.506. If the price reaches this level, your order is triggered and you buy at the next available price. Stop entry orders are great for catching momentum trades when you expect the price to continue in the same direction. Suppose GBP/USD is trading at 1.505 and you expect the price to keep rising if it breaks 1.506. You set a buy stop order at 1.506. If the price reaches this level, your order is triggered and you buy at the next available price. This order type is useful when you want to enter a trade only if the market shows strong upward momentum. If you think the price will fall further after breaking a certain level, you can use a sell stop order. For instance, if EUR/USD is at 1.205 and you want to sell if it drops to 1.203, you set a sell stop order at 1.203. If the price falls to this level, your order is triggered and you sell at the next available price. This helps you catch downward momentum and enter trades as the market moves lower. Stop loss order is designed to protect you from excessive losses. It's linked to an open trade and automatically closes your position if the market moves against you to a certain price. For example, if you buy EUR/USD at 1.223 and set a stop loss at 1.22, your position will be closed if the price drops to 1.22, limiting your loss to 30 pips. Stop losses are essential for risk management and peace of mind. Say you're long EUR/USD at 1.223 and want to limit your risk. You set a stop loss at 1.22. If the price drops to 1.22, your broker automatically sells your position at the best available price. This prevents further losses if the market keeps moving against you. Remember, in fast or volatile markets, your stop loss may be filled at a price worse than your specified level due to slippage. Trailing stop is a dynamic stop loss that moves with the market. If you're in a profitable trade, the trailing stop follows the price, locking in profits as the market moves in your favor. For example, if you short USDJPY at 90.8 with a trailing stop of 20 pips, your stop loss starts at 91. If the price drops to 90.6, your stop moves to 90.8. This way you protect profits while giving your trade room to grow. Imagine you're short USDJPY at 90.8 with a 20 pip trailing stop. If the price drops to 90.6, your stop loss moves to 90.8, ensuring you don't lose your profit if the market reverses. If the price falls further to 90.4, your stop moves to 90.6, locking in even more profit. The trailing stop only moves in your favor and never widens if the market goes against you. Easy to confuse limit and stop orders since both specify a price. The key difference is in their purpose. A stop order activates a trade when the market price reaches or passes your stop price, often used to enter on momentum. A limit order only executes at your specified price or better, ensuring you never pay more or sell for less than you want. Each has its place in a solid trading strategy. Suppose EURUSD is at 1.1 and you set a stop entry order to buy at 1.101. If the price reaches 1.101, your order is triggered, but the actual fill price may be higher or lower depending on market volatility. The stop price is just the threshold for execution, not a guarantee of the exact price you'll get. This is important to remember, especially in fast-moving markets. Now let's look at a limit order. If EURUSD is at 1.1012 and you set a buy limit at 1.1009, your order will only be filled at 1.1009 or better. If the price never reaches 1.1009, your order remains unfilled. This gives you price certainty, but you might miss the trade if the market doesn't move as expected. It's a trade-off between price control and execution certainty. Beyond the basics, there are some advanced or weird Forex orders that give traders even more control. These include special instructions like time-enforced TIF orders, which tell your broker how long an order should remain active before it's canceled. Let's explore these advanced order types and see how they can help you fine-tune your trading approach. Time-enforced TIF orders are special instructions that specify how long your order should stay active. They help you control the timing and execution of your trades. Common TIF types include good for the day GFD, good till cancel GTC, immediate or cancel IOC, fill or kill FOK, and good till date GTD. Each serves a different purpose depending on your trading needs. Good for the day GFD order stays active until the end of the current trading day. If it's not filled by then, it's automatically canceled. In Forex, the trading day typically ends at 5:00 p.m. EST, but always check with your broker. GFD orders are useful if you want your order to be active only during regular market hours. Good till canceled GTC order remains active until it's either filled or you manually cancel it. Some brokers may set a maximum duration like 90 days, so always confirm with your platform. GTC orders are great if you're willing to wait for the perfect price, but remember to monitor your trades in case market conditions change. Immediate or cancel IOC orders must be filled immediately, either in full or in part. Any portion not filled right away is canceled. IOC orders are useful when you want to get into a trade quickly but don't want to wait for the entire order to be filled. They're often used in fast-moving or illiquid markets. Fill or kill FOK orders are even stricter than IOC orders. The entire order must be filled immediately or the whole thing is canceled. FOK orders are best for traders who need all or nothing, no partial fills allowed. This can be important when trading large positions or in markets with low liquidity. Good till date GTD order remains active until a specific date you choose. If it's not filled by the end of that date, it's canceled. GTD orders are helpful when you want to set a time limit for your order, such as around major news events or before going on vacation. TIF orders give you more control over your trades by letting you specify how long your order should remain active. They help manage risk by preventing orders from lingering in the market longer than you intend. Depending on your trading style, you can choose the TIF order that best fits your needs, whether you want quick execution or are willing to wait for the right price. Additional orders like OCO, one cancels the other, and OTO, one triggers the other, add flexibility to your trading. OCO links two orders so that if one is executed, the other is canceled. OTO links two orders so that the execution of one triggers the placement of the other. These orders are great for managing risk and automating complex strategies, but not all brokers offer them. With an OCO order, you can set both a stop loss and a take profit order. If one is triggered, the other is automatically canceled. For example, if EURUSD is at 1.204, you might set a buy order at 1.2095 and a sell order at 1.1985. If the price hits 1.2095, your buy order is executed and the sell order is canceled, ensuring you don't have conflicting trades open. TO orders are useful for planning ahead. For instance, if USD CHF is at 1.2 and you believe it will rise to 1.21 before revering, you can set a sell limit at 1.21. If this order is triggered, a buy limit at 1.19 and a stop loss at 1.213 are automatically placed. This way you can set up your entire trade plan in advance, even if you're away from your computer. Recap: the most common Forex order types are market, limit entry, stop loss, and trailing stop. Each serves a unique purpose and helps you manage your trades more effectively. By mastering these basics, you'll have the tools you need to enter and exit trades with confidence. Remember, keep your order strategy simple and always double-check your broker's platform for specific features and fees. Before placing any trade, make sure you fully understand your broker's order entry system. Practice using demo accounts to get comfortable with different order types. Always check for rollover fees if you plan to hold positions overnight, and avoid overcomplicating your strategy with too many orders. Simplicity and clarity are your best allies in Forex trading.